What is going on, everybody? Welcome back to the Tim Warren Show. And in today's special live episode, we are covering the FOMC decision and press conference happening over the next 40 minutes or so. At 2 o'clock here in 9 minutes, we will be hearing the final decision. Will they be cutting rates in December? We'll go ahead and let you know the probability of them doing that, more than 97%. We will see a rate cut in the next 9 minutes. Okay, so probably not going to be too shocked when we get a rate cut decision. But what's going to be even more important, as we do this every single month, or what seems like every month, technically sometimes they take months off. What's going to be more important is, what does Jerome Powell say at the press conference at 2:30? Sometimes he comes out and he seems to be a little hawkish, and markets seem to do quite well. Sometimes he comes out, hawkish, he comes out dovish and things do well. Excuse me. When he comes out hawkish, things tend to fall to the downside. So whether we get a rate cut or not, and we're going to, the bigger question for everyone trading the markets right now is, what does Jerome Powell say at the press conference? Does he come out and kind of stick to the middle? Does he come out and say that we got a bright future, the economy's still strong, and more rate cuts are coming? Or will he come out and attack inflation and potentially imply that no more rate cuts are coming while he is chairman of the Fed? That would result in a big dump. I'm going to be very honest with you. We're going to give some predictions here later in the show, but I've been very vocal. Said it yesterday, said the day before. I don't think that the rate cuts have been priced in just yet. What does that mean? Rate cuts are a bullish thing. Price will respond positively. Yes, Bitcoin has gotten as high as $94,000 in the last couple of days. I don't think that's high enough. I've talked about it, and I will show you on the show today levels that I think would tell me it's been priced in, and then potentially have a pullback. But I don't think it's been priced in just yet. I think that we will see some form of a pump here in the next hour and change. In fact, the next 24 to 48 hours will be very interesting. That's not to say there won't be moments of perceived bearishness, in my personal opinion. I think that if there's one thing that is constant during FOMC days, whether we end up coming out of it being bullish, whether we end up coming out of it being bearish, volatility is the only constant when it comes to FOMC meetings. There's going to be moments over this show where you're going to be convinced that we are about to hit brand new lows on this pullback. There'll be other moments that make you convinced that the bottom is in and we will be skyrocketing to new all-time highs. We're going to cover all the information, tell you what you need to hear, break down the press conference after it is done so you have a better understanding of possibly what to expect when it comes to your portfolio. But stick around with us. We have a lot to cover on today's show. Smash the like button right now if you're excited about this information. If you're trading it right now, let us know. What are you thinking? Vote on the poll. Are we about to see a major pump? We're about to see a major dump? Or will we trade sideways in a nothing burger? I don't think that's going to happen, but let me know your thoughts down below. Make sure you're subscribed to the channel. I want to bring on my team here. We actually had the full crew on today. I got Smay. I got Shrum. I actually don't know if... Oh, Smay is on camera. Look at that. Look at that set Smay's got. What a great idea for a set. I don't know where you got that one from. We're going to have a good show today here, guys. I'm not going to ask you how you're doing. People don't seem to care how you're doing for some reason or another. They tell me in the comments all the time, don't ask them how they're doing. So don't ask me to ask you that question. Instead, I want to jump right to it, Smay. Pump, dump, or sideways action? What is your take?
Tim, I think it's going to be real exciting. I'm going to go with pump.
Pump. There we go. You got the bull in the house, mate. Shrum, how about you? You got your hodl hat on. Is that a depiction of your take here? Or are you going to go against the grain and predict a bearish outcome?
Tim, I think you got to prepare for a dump here on the news because that's going to be the misdirection because obviously this is a very pump-worthy day. I think there's very few things that Jerome Powell could come out and say that would lead to an actual dump. There's a couple, but there are a couple things he could say. I think we pump from here in the mid to long term, but I think in the short term, manipulators are sitting there licking their lips saying, let's dump this thing so that we can buy lower.
Yeah, again, I want to make sure we're very clear here. Again, we don't know 100% what's going to happen. We're going to have to see how things play out. I think it's going to be really interesting to see what candles do here in 5 minutes when we get the official announcement about the decision. Again, we're going to spoil it. It's going to be a rate cut. There's very little potential that they end up pausing rates. There's even smaller potential they raise rates. That's kind of off the table. But the question is, what does the market do? I mean, this is something we've known was going to happen for quite some time. So I think the only argument to be super bearish here is to take the opposite side of what I've said. to say that this is priced in. This was a very disappointing relief rally, despite all of the buy signals that came in. And I'll show you them on the charts here in just a couple of minutes after we get the decision. This is going to be a very disappointing rally. And then I would say if we end up having some sort of a dump, it could get pretty ugly pretty fast. I think that if we end up dumping here today, and that's not my prediction, but I'm saying if, things get pretty ugly because everything right now on the table, when you break it all down, is so very, very bullish. Quantitative tightening is officially over. Not just is quantitative tightening over, they have already started to print money and inject liquidity back into the market. So while we haven't officially entered into what's called quantitative easing, which historically is bullish for risk on assets like crypto, we kind of unofficially done it. Kind of similar to things we did back in 2020 after COVID decimated the economy. They started to not officially move into QE, but started to inject money back in. And it ended up causing major rallies in both the crypto markets and in the stock market. That's what we're quietly seeing happening. We've also heard some rumblings in the last couple of days. Some birdies have been tweeting out there that while some expect we might not see the Clarity Act, which is a massive bill that will be big for institutional adoption of crypto, some have said we have to wait until Q1, early to mid Q1 to finally get that passed. There's been some little birdies out there tweeting we might actually see that resolved before the end of the year. So major banks have come out in the last couple of days talking, not just talking about price predictions, right? We have seen price predictions. We've actually seen banks coming out showing that they have been buying, that they're making plans to offer this to their customers early in Q1. And I'll tell you this right now, no customer wants to buy a dying asset. That's just the mindset of retail investors. People don't buy an asset that has been falling. They buy assets that have been rallying. They want to buy into confidence. Well, with these recent announcements that all these new banks and firms are going to be offering Bitcoin and Ethereum and several other altcoins to their clients, they need to see sustained rallies before that offering actually happens. So I take all this information, and Shrum's going to break some down here in a couple of minutes after we get the results. I take this information and it makes me continue to lean. I don't think the top of this relief rally is over. I still think there's moves to the upside. I also want to sit here and tell you, I've been tweeting out today. If you guys don't follow me on X, I highly encourage you to do so. Give me just 1 second, Shrum. Go to my page now and take a look here. Some of you guys are watching right now on X. So glad you guys are here. You guys are watching right there. Others of you are watching on YouTube. Follow me on X. It's a good place to follow. So I'm putting out a breaking news. I'm putting out my thoughts overall on macroeconomics. But I've been tweeting here a little bit and getting some pretty negative results, right? So I tweeted earlier today, rate cuts are not priced in, rally more than likely coming this afternoon. You guys have seen, we had a bunch of comments coming here. And while there were a couple supporting, most of the comments in here are people telling me that I am dead wrong. Okay. Well, this caused me to retweet out here. I said this overwhelming pessimism in the comments to this tweet are one of the biggest reasons to think I'm going to be right on this. People are in disbelief stage. Well, you might have read that and said, Tim, what do you mean disbelief stage? Disbelief is where no matter what bullish things happen, people are so ingrained to be bearish that they just don't buy anything bullish whatsoever. And everything coming out right now is bullish. I understand why they're that way. We have seen for the last couple of months, good news seems to be bad news. But the difference between this situation and the past is in the past couple of months, while everything's been moving to the downside, people have been extremely optimistic when good news comes out. And then they get their souls crushed when it ends up going to the downside. Well, now people have gone ahead and cemented their hearts. They're just saying, no good news out there can make me feel good. We have to crash during this FOMC meeting. And when the retail gets to that spot, when it feels like nothing good could ever happen again, that's when you start to flip and the good news actually becomes good for price action. Let me know right now in the comments, do you guys disagree with that? But I'll tell you this right now. The overall pessimism in the markets today, to me, is historically a very good sign. Guys, it is 2 o'clock, which means we just got the decision here. Let me see if my page will refresh. Where we go here? FOMC. Oh, yeah, it's got to refresh here. Just a second. It does look like we got it's coming in. We got to see 3.75 for this to be official. I don't know, Shum, if you see the official data points, but they're watching with me live as this little thing is updating for us. Yeah. So give it 1 second. Do you see the official announcement just yet on your end? It is 2 o'clock.
Yeah. So, Fed cuts 25 basis points per zero hedge. If you go over to my screen here really quickly, we have a pretty big announcement already. Boom, says zero hedge. Fed says it will begin Treasury bill purchases on December 12th.
Wow.
So we'll hear a lot of questions from the press briefing about that statement. We also get the statement of economic projections. That'll be something we digest. But Tim, just quickly, what does this make you think that the Fed put in their statement that they're going to begin Treasury bill purchases, and how is price reacting?
Let's get to that in just a second. Let's look at the charts here for a second. There's been some volatility already in the last minute. Let's go to the minute charts here. You'll see some chaos. The news came out. Big volume came in here. We spiked back up over 93,000, getting to the highest level we've been today at 93.2. Then, of course, in this second minute out here, we've come back down to 92.7. I told you volatility is going to be embraced. Initial spike up, volume confirms, bulls are buying, but now you got some people taking profits. So the war's already started here between the bulls and the bears. By the way, when you look at other coins like Ethereum skyrocketed back up of 3,400 here on the news, 34.33. It is, of course, look at that nasty wick down. Wick is high in the last 2 minutes to 34.34 and down as low as 33.71. The chaos has started. Let's look at some other coins, what they've been doing. XRP, big move up to $2.08. Now it is trickling down here at 2.06. You can see the ping-ponging back and forth. Solana made it as high as $139, Now it's back down to 138. Chainlink made its move up towards 1464. It's back down here. So initial pump on the news. Now we're seeing a little bit of a cool off. There's a lot of things that will still be unpacked, not only in the next 30 minutes. So we're going to unpack that. We're going to talk about news. We're going to follow some charts here. Probably going to do news and then come back to charts in a couple of minutes. But then it'll get even more fun when Jerome Powell takes the stage. But you're seeing the instant reaction here on the charts to the news. It was an initial surge. Now we're getting a little bit of a dump. So all the bears out there right now are saying, Tim, look at this. It's all bad. Guys, we got a long time. We got a long time before we can make any type of declaration on what this truly means. In fact, I'll go ahead and tell you, this might be one of the more bullish opportunities that I've seen here. The fact that we just got the news and we're pulling back pre-press conference, that actually could set up amazing buying opportunities for long positions to shoot back up during it. But we'll keep you tabbed. We'll keep you up there. I kind of have a good line in the sand. I want to see a stay above 91,000. If we start to lose 91,000, we'll have a conversation here. Let's go back, though. Go off my screen here, Smay. Let's talk about the question you asked me before I went to the charts from. You said, what are my thoughts about this news with the Fed? What was the exact statement? I don't want to misquote it and say something wrong. They're going to be doing what on December 12th?
Good question. So they're going to be beginning a Treasury bill purchases. They will begin Treasury bill purchases. And Tim, I think this is a seamless transition into what the news that we had here. But I think I don't know that your reaction is going to be very different from that's bullish. That is a very bullish thing. That's QE, right? It depends how they.
What I just talked about in the intro, it is not. They're not officially announcing quantitative easing, but they're doing the same types of things that you do during quantitative easing. In the same way, we didn't technically go into quantitative easing back in March of 2020 when, again, COVID decimated the economy. But what we do know is they turned the money printer on. We saw the Fed start to buy back in and start to inject the markets with liquidity. It was a silent, quiet, fake QE, but it had all the real implications of it. What they're officially saying is in 2 days, they're doing the same thing they did back in 2020. And if you go back to my chart here, Smay, what did the markets do post that time period where we had, again, fake QE, not official, fake QE? We would watch Bitcoin's price explode, bottom out at $3,800, but then in the next couple of weeks, get back up above 10,000. Yes, it would then spend a little bit of a boring time during the summer of 2020 before absolutely ridiculous bull run happening in 2021. I want to be clear. I'm not expecting this fractal necessarily to play out. I'm not telling you to go take this same movement and say that's going to play out today here as well. What I'm saying is this is a continual injection of liquidity. One of the biggest reasons why 2025 has been boring sideways. A lot of the altcoins are actually lower than they were to begin the year, has been because we thought that this year would be injected liquidity. When Donald Trump and his administration took office, we thought that he would solve a lot of the big problems. We thought that he would do things that would cause the Fed to go into massive rate cuts, to start injecting liquidity back in, to have quantitative easing. And instead, due to tariff concerns and war concerns, 2025 has been a very topsy-turvy, volatile year that ultimately is leaving us with a chart that looks like this on the yearly chart. Let me zoom in so you guys can see it. We actually right now have a bearish year. Now, again, we have what? 20-something days, 21 days until the end of the year. But you get my point here. It's actually been technically on paper a bearish year for Bitcoin and much of the crypto space. Why? Because liquidity wasn't here. What you're seeing happen in this news, when you're seeing the end of QT, you're seeing more rate cuts coming, and now you see that they're buying treasury bills, the Fed is, this is the injection of liquidity that is still making me believe, like I said yesterday, that 2026 will lead to a super cycle, a breaking of the 4-year cycle, and should have a very large white candle when we look back on this a year from today. Shram, give me your take on this, and then we'll jump into some other news and maybe take a look at some big charts to look at some support and resistance levels to keep an eye on here today.
Yeah, well, I will be surprised if this name is not dropped at some point during the press briefing, and it is Mark Cabana, not Mark Cuban, Mark Cabana, ex-New York Fed repo guru. Now he's over at Bank of America as an analyst. He said this earlier this week, Powell could announce a $45 billion a month treasury bill purchase, and 20 of that would be to keep pace with growing liabilities, and $25 billion would be to refill drained reserves. This is just Cabana's prediction for now, but this week could see stealth QE transition into overt QE. So we told you all that this week, the 7th of December, and just 3 days ago. And now we're a little bit closer to having that be confirmed to be true. The transition from QE as stealth QE into overt QE. We also have a couple other updates here. The Fed cuts benchmark rates. Okay, so they cut the rates. But we had 2 dissents, and the dissents went in opposite directions today, representing that divide that folks who really get into the inside baseball of the Fed, they've been highlighting this divide within the Fed. Fed Schmid, Goolsbee, dissented in favor of no rate change. So that's, I believe, 2 dissents. One co-signed the other. Yeah. Schmidt and Goolsbee dissented in favor. They said that you should have held the rate steady. Fed Mirren dissents in favor of a 0.5 point cut. Mirren is the new board member put in by Donald Trump, nominated in there by Donald Trump, similar to how Supreme Court justices get nominated and confirmed. So one interesting thing that pops out to me about this, Tim, is you don't see the name Powell as the dissent, which means that Powell himself voted for the cut. And usually we don't get information about how the split went, but I have an update here from Financial Juice that says the vote in favor of the policy decision was 9-3, with Mirren preferring a 0.5 percentage point cut and Goolsbee and Schmidt preferring no cut. So there is one more that voted against the cut. So perhaps that was Jerome Powell. Getting into the nitty gritty, this stuff doesn't really matter. They cut, but for those of you who are big fans of watching the financial markets revolution here, this is some exciting stuff. Tim, that's what I'm seeing right now. I'll keep scanning for more updates.
Could be wrong. I'm about to say something, Shrum, that might be right, might be wrong. I don't want people to take this and say, well, Tim said 9-3 and then 3 names are mentioned. Is it possible that Mirren's counts as a dissent since he wanted to be more aggressive at 50 points? Like he said 9-3 and then listed 3 names. Like that makes me believe the only people who didn't vote for a 25 basis point cut are those 3 people. And of course, Mirren, he's in the dissent just because he wanted more cuts. I could be wrong. Could be wrong.
I think you're right. I think that is how to interpret that.
Let us know in chat. If someone in chat is smarter than us and knows how these things work, let us know in chat. Yeah. I'm kind of spitballing on that one.
Yeah, we're all trying to process this in real time.
So there's a guy in here. Felix is in chat. Love Felix. He comes in all the time. I love Felix because if we get super bullish, Felix is like our biggest fan, right? He loves when we're bullish. If I ever say anything to suggest that anything bearish could happen, Felix thinks I'm a clown. Love you, Felix. Glad you're here. He said, I can't wait to get the new Fed chair next year to cut 0 rate. to cut. I guess you meant to cut zero rates. Let's go, new Fed chair. There's a lot of people out there who really go after Jerome Powell. I'll say this: there are things that Jerome Powell has done in the last year, especially last year and some change, especially that make me scratch my head. I think there are moments where I actually am on his side. I'm saying, you know what? I applaud Jerome Powell for doing something that seems to be anti what his politics represent. But then there's been other moments where I'm like, no, that seems to be something that is politically motivated. So he's someone I haven't quite got a grip on just yet. I am neither going to be as happy as some that he's gone, nor as disappointed as others. I neither have a great love for Jerome Powell, nor a great hate. I think he's done a decent job at certain moments. I think other moments make me scratch my head. My biggest two issues with him have been 2022 when he drug his feet and took way too long to start raising rates. Some of you were here for that. We were talking about that in detail, that a big mistake was waiting. And sure enough, it caused a recession that the government didn't want to cause a recession. But you guys remember 2022, everything fell. I think Jerome Powell knows that. I think he's all but admitted to it. Yeah, I took too long to start raising rates. But then you get into 2024, and it was just very curious. Out of nowhere, he wanted to cut 50 basis points in September. I don't particularly want to go too deep down that rabbit hole. Seemed to be politically motivated. Whether you think it was or not, it didn't work, because of the perceived notion was he did that to try to help the Biden administration and keep the Democrats in power. Didn't work. Donald Trump did win the presidency, but all of a sudden then Donald Trump becomes president, and he goes into this mode of saying, oh, we need to wait and see data. We need to wait and see that things are in trouble. Whereas in September of 2024, he went ahead and said, well, we don't have the data for it, but let's jump it. We don't want to get anything out of control. Seemed a little political and motivated. But what I'm seeing right here, anyone who's saying they're mad at Jerome Powell, it sounds like Jerome Powell voted in favor of a cut. So do I think things will be better in May? Do I think that we'll have a stronger economy in May? Do I think more rate cuts will come and we'll officially enter QE in May of 2026? Yes, I think so. I really think we will. So I'm kind of in somewhat team. Yeah, let's get a new Fed chairman, but I don't want you guys to hear that and be like, well, Tim hates Jerome Powell. I think Jerome Powell's been a complicated man who possibly is trying to do the very best he can, but sees things differently. I think he was a little too late to start raising rates, and now he's a little slow to the major cuts, but the cuts are coming. And quantitative easing, whether they announce it officially or not, is coming. The question's going to become, does it happen on your guard, Jerome Powell? And do you go out with a little bit of, all right, he did his job. He did what he thought was right. Or will you keep stonewalling and wait, in which case maybe you end on a sour note? Let me know in the comments what your guys' thoughts are, but that's just where I am. I'm not necessarily his biggest fan, but I'm not his biggest detractor either. We'll see how that one goes. Let's go take a look at price action here again. In 15 minutes, Jerome Powell will be live. We'll be covering that here live. Go to my charts here, Smay. You guys, I saw chat saying, Tim, you were wrong. We're crashing. There we go. We're going back up. Let's go to the minute chart. I'll show you guys the minute chart. Look at the volatility. I told you guys the one constant on FOMC days, whether we end up being bullish or whether we end up being bearish, the constant is volatility. And after shooting up to 93.2 and then falling all the way back down to 91.7, we're back above 93,000. What does that mean, guys? Does that mean I'm right? Does that mean Tim got it all? No, it doesn't mean anything. It means that FOMC is volatile. What I want to see to declare I'm right is I want to get all the way through the press conference. I don't care what happens during the press conference. I don't care if what we end up seeing during the next hour looks like this. I just don't care. What does price action do in the next 30 minutes to an hour post FOMC? And then more realistically, what do the next 24 hours look like? If I know anything about studying these markets and what happens during FOMC day, the volatility is the craziest while Jerome Powell is speaking. It starts to show a little bit of a direction of what's happening after he's done, but we really don't know how the markets want to take in the information for about 24 hours. So tomorrow afternoon, when we're live at 3 p.m., we will be able to declare then, was Tim right and the top wasn't baked in with this rate cut, or was Tim wrong and it turns out it absolutely was, and we're heading, I'll tell you right now, if the top is in on this relief rally, if I come back over here and look at like the 4-hour chart here, if this was the top of the relief rally that we called a couple of weeks ago, back when we were down at 80K, then we are going to have a very large move down. I mean, in that case, I've told you guys, I think there's a good chance we could still hit 74K. If the top's in right now, I'll just be brutally honest with you. Bearish action with everything good that is happening right now, that is a strong case that we need to start making a move down to 70, 60, and possibly even down towards $55,000 to $50,000. That would be my case. I still believe, though, and I've been telling our VIP trading group this, I've been telling you guys here live on YouTube, I still believe that what Bitcoin really wants to do is get back to a decision point. A decision point will be the 200-day moving average. We're still well below it. We've got a lot of room to the upside. I've located and told you guys there's some big resistance. Look at this. Actually, 50-day moving average is dropping just perfectly into that corresponding resistance level just below 97,000. I think we will hit 97,000 at least. My question is, do we get closer towards 103? Do we get back to former support from back here in October? Do we start to run into the 200-day SMA? That becomes a decision point. This is dropping right now. If I were to grab my marker right now, this is dropping as we are speaking, right? Over the next couple of weeks, this will keep dropping. Oop, did not want to get rid of that one. I want to get rid of these. There we go. I still think that we have a good chance of price being volatile and making its way up towards that 200-day SMA. What happens at the 200-day SMA is now the big question. It's decision point. Do we see a break through this? Maybe a retrace, use it as support, and then take off to the upside. Bull market confirmed back on. All right? Or do we see a rejection at the 200-day SMA and start to make a move back down? This, of course, would look very eerily similar to the bear market of 2022. What did we do? We lost the 50-week moving average. We started to enter into a bearish trend. We had a relief bounce that convinced people the bull market was back on, only to get rejected right on the 200-day SMA, and the long winter of the Bitcoin bear market would begin. That's what we're watching. That's the decision point. Do I think that we could have a bull market still on? Absolutely. I still even think there's a chance that the misdirection doesn't stop there. I think there's actually a decent chance that Bitcoin rejects on the 200-day SMA, makes its move lower to convince retail the bear market's here, gets a double bottom here towards 74,000, and then we have our takeoff with all the liquidity and the bills passing that pump money from institutions into the crypto space. Retail will be gone. Retailers who are fickle will be gone. Only the strong will survive, and it'll be the strong and the patient and the institutions that reap the benefits of the bull market, not retail. So we'll have to wait and see how that one plays out. But between now and then, we got to decide, before we even get to that 200 SMA, you got to decide right now, do you think the top is in right now, or do you think the top, or do you think that we have a lot more room to the upside? I would tell you what I'm looking at. Daily chart has remained bullish after the buy signal we got back here in November. Even when you go to other places, you take a look at charts like, let's say, the 4-hour chart, which did give us a very minor bearish divergence. But you're seeing, when you look at the RSI, when you look at the MACD, there's still a whole lot of room to the upside. We're not getting confirmed sell signals just yet. You look at lower time frames like the 1-hour chart, and you're seeing we are sustaining some bull runs. And oh, by the way, we were talking about this in our VIP trading group today. Weekly chart. The weekly chart, I've been telling you guys this for a while. When you look at this indicator, very close to a bullish signal. Bullish divergence is in on the weekly chart. But we also have a green dot about to flash. The money flow is slowing down. The reason I know that is because the weekly MACD has started to put in some light pink histograms. And money flow and MACD aren't identical, but they're similar. When you see the MACD start to print light pink, that's a good sign the money flow is about to flow back positive. Look at the last couple of times we've gotten this type of a signal. You got to go back to April of 25, major bottom. September of 24, major bottom. September of 23, major bottom. Even go back into July of 2022, major bottom. These indicators, along with these green triangles, you go back and look at the history of these things flashing. Even in bear markets, you get sustained bullish bounces back up. There are a lot of things on the charts that are looking very good. I'll tell you right now, the only chart out there that I'm saying, I don't really have too many arguments to say that this is bullish, it's got to be the monthly chart. And I'll make one argument. That we could sustain a bull rally despite this indicator. But take a look at this, guys. The MACD on the monthly chart confirmed bearish. The last couple of times we've seen this happen, of course, you got to go back to January of 2022, bear market. Before that, you did see little time periods of fake outs like back here in December of 2019. That wasn't a full-blown bear market, but we also weren't sitting at a super high level. Before that, you saw July of 2018. That was a June 18, excuse me. That was in the middle towards the end of the bear market, but still confirmed a bear market. The only argument I'll make, because I really can't do too much to argue against this indicator, is looking at the stock market world. When you look at the S&P 500, we had a fake out earlier this year. Look at this. We crossed bearish on the monthly MACD on the S&P 500 back here in April of 2025. Guess what? That was this big fake out to the downside. Yeah, it was a good correction. Was not a bear market. Maybe you did call it a bear market. I don't know. Maybe you did. It was down 20%. At the end of the day, I don't call it a bear market. And this is an indication institutions ignored the monthly bearish cross and we went on to set new highs. Well, why is that my argument? Because while Bitcoin historically, this has been a doomsday indicator, I've told you already, this is a time period where we are very different in the past. I think it's the institutions who are in charge. We just watched them ignore a monthly MACD bearish cross. Will we see it happen for Bitcoin as well? That is going to be a big, big, big question. A lot of things on smaller time frames. Daily looks bullish. Weekly looks bullish. I think the 4-hour chart's the only one you're looking at right now saying, hey, maybe we see some chaos still happen over the next couple of hours. But a lot of signs to me are still indicating we are bullish. When you look at the news, it's extremely screaming at us, we are bullish. By the way, throughout all of this chaos, let's redirect and talk not specific altcoins, but maybe a couple altcoin details. We do have our Bitcoin dominance falling back below 59% again for the first time since back here in November on the 26th. So during this rally, again, Bitcoin has been rallying the last couple of days. Bitcoin dominance continues to fall to the downside. Why? Well, you're seeing things like Ethereum breaking former support that got turned into resistance. Could Ethereum be making a very, very big move right now? It's back up over 3,400. Other coins like Chainlink making some big sustained moves. This is a very bullish season. You look at the altcoins that specifically institutions are interested in. You're looking at Ethereum and you're looking at Solana with their recent ETFs and you're looking at Chainlink. You're seeing sustained bullishness happening. Even a coin that's been down really far like Ondo the last couple of days here has started to get a little bit of a surge back in. These are institutionally friendly coins that are causing the Bitcoin dominance once again to fall to the downside. This is a very, very bullish thing for crypto overall. Tomorrow, if you're wondering, I will be going into detail because it's not just Bitcoin that's getting these weekly buy signals starting to creep in. Other altcoins are as well. And while yesterday's live show, I kind of talked about what that could mean for Bitcoin's price not tomorrow, Friday's video. There will be a video coming out on Friday. Friday, I will go into detail. If we get this confirmed bull market or confirmed weekly buy signal on some of your favorite altcoins out there, especially the institutionally friendly ones, what could that mean for price action? I'm not making 100% guarantees about anything in terms of price predictions, but I will tell you historically what do these buy signals mean and just how high could some of your favorite altcoins go back up in the next couple of months. By the way, you off my screen here for just a second, Smay. Whether you agree with me or not, whether you think Tim gets a lot of things right, or whether you think, man, I can just trade the inverse Tim. Like if Tim's bullish, I'll go bearish. If Tim's bearish, I'll go bullish. I know some people claim to do that. I don't think you're that successful, but be my guest. Do it. Here's what I'll tell you. Go trade it and make some money. If you agree with me, trade and make money with me. If you disagree with me, trade against me. Fade my picks and make some money. Just go do it on Toobit. Why should you do it on Toobit? Because Toobit is the best place for you to get the cheapest fees, the greatest liquidity, and the best customer service. If you look at events like October 10th, where people lost a lot of money on exchanges, Toobit was probably the best exchange out there at guaranteeing that people didn't lose everything. Their liquidity helped people get out of their trades. Their stop losses were not skipped. And in rare circumstances where people did lose a lot of money, Toobit was giving money back to people because they do not want people to walk away from their exchange. Exchanges are dangerous with money. I mean, we tell you all the time, when you're trading, you need to take into account you're risking a lot. But when you're trading on Toobit, it's not necessarily as risky. And when you use our link down below, you automatically get access to VIP level 1 fees. They already have some of the best fees out there. It's even better when you use our link. And even better, here you go. Go to my screen here against May. You're watching this video right now on YouTube. If you're on X, go over to YouTube real quickly. Go into the description. You'll see our link tree right here. It's the top link in the description. Click on it. You'll see this right here. Click on our Toobit exchange. And when you do, and you deposit $100 or more, you'll get access to all of our private live trading sessions. Myself and other pro traders, you'll get access to our trade entries and exits. You can see what I'm buying, when I'm buying it, what my plans are. If you deposit $500 or more into Toobit right now, you'll also get entered for monthly giveaways, cash giveaways, membership giveaways, all of that. Go trade and make some money on Toobit right now. Let's check back in here. I want to throw it to you in just a second here, Shrum, but I want to check back in price. Bitcoin kind of camping out here over the last couple of minutes. Go to the minute chart here. Kind of finding some nice zones of support right here around 92.6. You can see a couple bounces right here in the last couple of minutes. We are 4 minutes away from Jerome Powell being live. It'll be very interesting to see what he says. Stick around with us. We'll watch the charts. We'll watch the press conference. For the last couple of minutes, though, I want to throw it to you, Shrum. Get your take, your predictions. Tell me, what are you expecting here in 4 minutes from Jerome Powell? Will he be hawkish? Will he be dovish? How do you think price action will respond over the next 45 minutes? Take it away with your opinion.
I just don't see a way around it being bearish. I mean, there's going to be manipulation, right? So there'll be in the short term, price action could go anywhere. But the takeaway I'm seeing so far is pretty bullish, because we're seeing almost to the T the prophecy that we saw on the 7th that was coming out from Mark Cabana, said 45 billion monthly treasury bills. Well, we just got that. If you go over to my screen, NewYorkFed.org, they just announced this. Monthly amounts of RMPs will be announced on or around the 9th business day of each month, alongside a tentative schedule for purchase operations for the subsequent approximately 30 days. So on the 9th of each month, they're going to tell you how much they're going to buy that month or over the next 30 days. The desk plans to release the first schedule on December 11th. That's tomorrow, with a total amount of RMPs of approximately 40 billion. So he was 5 billion off, but it's approximate, right? Approximately 40 billion in treasury bills. Purchases will start on December 12th. The desk anticipates that the pace of RMPs will remain elevated for a few months to offset expected large increases in non-reserve liabilities in April. After that, the pace of total purchases will likely be significantly reduced in line with expected seasonal patterns in Federal Reserve liabilities. Purchase amounts will be adjusted at the appropriate based on the outlook for the reserve. So this is I would say not really QE. It's kind of like that, but essentially there's been a dearth, a scarcity. It's kind of gotten below ample, right? Which is the amount of reserves that the Fed feels comfortable is in the private sector. So a bunch of banks out there, they have a certain amount of treasuries. The Fed's looking at that amount of treasuries. They're saying, that's not enough treasuries. You guys got to have more treasuries. And so the Federal Reserve is going to inject 40 billion approximately per month. And that's going to go up and down. And they're going to let us know how much up and down it's going to go on the 9th of each month. 40 billion is still quite a bit of money, but it seems like it's narrowly trying to cure this issue of offsetting expected large increases in non-reserve liabilities. So that's kind of Fed speak for the amount of the reserves is too low of treasuries. So there's going to be a cure to that. This is not a reaction to a big crisis like the COVID pandemic or like the 2008 housing crisis. This is a much more narrow need that's just kind of not enough treasuries in the financial sector, and they're going to take some steps to cure that. That is genuinely, it's in the direction of quantitative easing. It's not going against the tide of quantitative easing. It is expanding the money supply in some sense, or making money cheaper. However, this is not all-out QE. QE, I think, as some analysts have been putting it, it really needs to have a big, scary emergency that the Fed then can kind of reload and pull its big guns at. This is kind of a small, more of a sniper shot at a specific dearth of treasuries within the private banking market. So that's my interpretation of that. Still, though, right on with Mark Cabana was predicting earlier this week.
Yeah, excuse me. It'll be very interesting to see how all that plays out. Again, like you said, it's not technically QE. It allows them to not officially announce QE, but for all intents and purposes, it is QE. Like it is quantitative easing. It is printing money. At the end of the day, I don't care how you bake the bread. I want to eat the bread, and the bread is liquidity. So wrap it in whatever you want, bake it in an oven, put it on a pit, make it in a fire. I just want the bread. The bread is liquidity. They're bringing it to us. They're bringing us the bread. Guys, it's 2:30. Shmay, where are we looking at with the press conference? Is Jerome Powell making his stage just yet? There it is. He's not there yet, but we'll keep an eye right there. We'll be watching the price of Bitcoin. I might flip to a couple other assets while we're live there. He's coming out on the stage. We'll be live with you guys. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Nothing hawkish about that. That's pretty good.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
That's why there's no such thing as a recession anymore.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk
how
about it in
how
a very
to read it.
positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Not a good sign for cuts in January.
Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So people can't buy homes.
The idea is that with now having cut 75 basis points more now, and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
Golf
I guess I
reference.
wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
No.
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s. Let's put it that way. But we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, our framework, as you know, says that when that's the case, then we try to, take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now, or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people
We know
are
a lot of rich
experiencing,
people.
really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. Here. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a,
You didn't
had a
say
world
anything.
where
There's some big boys
there's
buying
just no
right now.
growth in workers and you really don't need a lot of
There you
jobs
go.
to have full employment, some people argue that's what we're looking at. But I think
that
a world
volume
where
that came
job
in on that
creation is
candle.
negative, I just think we need to
Brokerage
watch that situation very carefully
Big
and
buy
be in a
came in
position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
On the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think, again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right. Having a nice cool off here towards the end of this, but listen, Bitcoin breaking above the highs we'd had today. Very, very good sign. I'll say this, we're gonna be kind of quick. Got word while we're live, my 2-year-old Brody spiked a fever this afternoon. So he had a history, some of you guys know, of seizures, febrile seizures. He's young, not life-threatening, it happens. but it's obviously very scary. So my wife asked me to wrap this up as fast as possible so that I can go help take care of him, keep his fever down. So hopefully you guys understand. In a nutshell, though, the moves we made here on Bitcoin, getting back up to the highest point today, making it back up as high as 94.5. I'm not ready to ride a train. Anyone wondering who came in here early, I told you guys early on, I did not think this price was baked in. I thought we would go higher. I'm not about to sit here and say, guys, I was right. Look at me, because there's a lot of things that still need to happen. A lot of things that still have to unpack. I told you before we were over, or before in the intro, you find some answers in the meeting. You find the majority of them in the following 24 hours. So come back tomorrow to find out if I ride a victory lap of I was right. Come back tomorrow, find out if I say, well, looks like it was baked in, the top was in, and we're about to head back down. It will be 24 hours for that to happen. But I'll tell you this right now, this sustained bullish movement, this is the 1 hour chart, the bullishness that's still showing in place here, it's a good sign. I really do. I'm going to continue to ride the wave I started this show off with. I don't think it was fully baked in. I think people were expecting more hawkishness from Jerome Powell. And I think the only thing I walked away from this, and I want Shrum's opinion here in a second. Again, we're going to keep it brief, wrap this up with a pretty bow. The entire meeting overwhelmingly, in my opinion, was dovish, except his response to January rate cuts, where I'm not going to call it full-blown hawkish because he really didn't say much. He pretty much said, oh, we got to see the data, and we're not going to have the complete data. It's just funny to me when he talked about how he's going to rely on that data. It's like, well, we have to look at it skeptically. Well, that's not a measurement. How do you, if you don't feel like the data is accurate, you should just throw the data out and only operate with data you find reliable. You can't start guessing at data. That would break everything Jerome Powell has said as being a Fed chairman up to this point. So I thought that answer was a little peculiar, but as you can see, the markets rallied after that. Overwhelmingly, I thought it was a good press. I thought it was a good press conference. I thought it was bullish for markets. Again, we clearly went up. We have some cool offs. We did hit some resistance levels. I saw over in our private VIP chat, our guy Silent, who's a volume expert, he saw some things. He entered a short up here closer towards 94.3, excuse me, because he saw some shorts coming in. He saw the volume turning. Volatility will continue, but I'll tell you this right now. I'm looking at these charts. I'm looking at the sustained. Again, daily chart has remained bullish. I'm not seeing something causing me on the daily chart to start freaking out here. Even the 4 hour chart, it's in a weird spot right now, but it's kind of staying and ticking back to the bullish trajectory here. Let me pull up the RSI and MACD once again. You're starting to see some bigger green histograms here. I've told you guys before, and I'll say it again. I've said this the other day. I think the first level of resistance I'm watching, if we get up here to 96.7 to 97,000 area, if we had done it before the FOMC, I told you guys I would have thought this was baked in. Didn't get there. It's one of the biggest reasons I think we have more rallies coming. Someone asked in chat, Tim, where's the next level of resistance you're looking for? It's still this order block up here. Do we make a move up towards 103? That's going to be the question. I definitely still think that is on the table. It's very doable. So far, this press conference is dovish. It's bullish. We're moving to the upside here, but come back tomorrow at 3 p.m. We'll kind of be able to wrap a bow on what did the FOMC meeting really do and what did it accomplish and what's the next step for price action. That's my take on this, Shrum. I'll let you, maybe a 2-minute, 3-minute take here. Give me your quick feedback and thoughts, and we'll wrap this up. Guys, smash the like button right now. Make sure you're subscribed to the channel. Thank you for being here with us. Shrum, closing thoughts from you.
Yeah, I think it's a very bullish takeaway. I wouldn't say it's steaming hot. I wouldn't say we're ripping higher. And why do I say that? Is because the markets are saying that, right? We're not seeing crazy movements to the upside. The Russell's doing quite well, and that is a very bullish sign to see the index for small cap stocks do pretty well. Microsoft had a pullback, so that alone kind of brought down the S&P and the Qs from seeing any kind of breakout. But
S&P 500 is looking good right now. The S&P 500, it's I think we hit a new not a new all-time high, but we hit a new high for the last couple of days on the S&P.
Yeah, I think as silly of a question as it was, I think one of the more interesting questions to me was the question about Jerome Powell's legacy. And the way he answered it was, I think, very honest and kind of reminiscent of his tenure at the Federal Reserve, which is he's not going to come out and say that he cares about his legacy. He's going to say he cares about keeping inflation at the target rate and unemployment low at the target rate. That's his legacy, is trying to keep these things where they are. That is kind of the the culmination and the summary of what the Federal Reserve has been up till now, but we are cutting into a transition where Jerome Powell, representing Keynesian economics, representing the classical way to operate Western monetary policy, we are transitioning into something that is different from that. We're transitioning into debt to GDP ratio north of 120%, and that having to now be a third axis that the Federal Reserve is going to have to address, along with sky high, along with issues in the housing market. It's not just going to be about inflation and unemployment anymore. It's going to be about debt, crazy debt in the United States. Also, our friends in Japan have some pretty extreme debt situations. They're going to need to be addressed, probably have to get some help from other central banks. So overall, we are having dovish movements, cuts, and not hawkish press conferences moving into that transition. This tells me that asset prices are likely to continue to move higher. Investors, while there's jitters in the market today, and those jitters may continue for several more tens of hours, investors are hearing this news and they're hearing, okay, so this is bullish, this is dovish, and we're transitioning into Hassett being the new Fed chair or whoever Donald Trump is going to pick. This is a recipe for unprecedented amounts of lowering the cost of money, of getting loans. And who knows what kind of quantitative easing, exotic quantitative easing strategies are going to come when we have a Trump designed Federal Reserve. So that's all I'm going to say. I think the legacy question was very creative. Tim, I'm very grateful for the Tim Warren Trading Group. I'm very excited for all the people that have been joining, took advantage of the Black Friday deal. The memberships are still available, but the deal is now over. But we're very excited that so many people jumped in. Record membership sign up. So and they're sticking around and finding a lot of value in the membership group.
Yeah, love that group. Every single day, we're talking charts, we're talking news, we're talking what this means for portfolios. So if you guys want to, come join that VIP trading group. Again, the sale is over, but the details and the benefits still there. By the way, some of you guys are going to be asking in chat, man, we missed Shrum on all the shows. Why is Shrum not on all the shows? Well, Shrum is doing his own show now. Go to my screen here, Smay. Make sure not just to like and subscribe to this channel, but go check out the Taylor Shrum channel right now. Taylor Shrum Crypto News. Every single day, he is going live in the mornings at, I think it's 9 or 10 a.m. Eastern Standard Time, giving you all the morning news you need that impact your crypto portfolios, your stock portfolios. So make sure to subscribe to Taylor Shrum. Go follow him every single day. Go off my screen here, Smay. Love you guys. Thank you so much for being here. Smash like on your way out. Hit subscribe. Hopefully we continue to see this bullish rally. Come back tomorrow. We will confirm it.